Hello students, I'm Dr. Anita Pandey from Sri Shankaracharya Mahavidyalaya Junwani Bhilai, and today I'm going to tell you all about debentures. So let's first have an introduction as to understand what exactly are debentures. So speaking in layman's term, a debenture is the acknowledgement of the debt the organization has taken from the public at large. Now, what do you mean by acknowledgement? So acknowledgement is recognition or acceptance of something. So, speaking in simple terms, a debenture is the acknowledgement or recognition of a company that it has accepted debt from the public. They are very crucial for raising long term debt capital. Debentures often rely on the creditworthiness and reputation of the issuer for support. The meaning of this statement is that the more goodwill or the creditworthiness that an organization enjoys in the market, the more people will be willing to invest in its debenture. For example, if Reliance Industries Limited issues debenture, then many people will be interested in investing their money in the debentures of Reliance Industries Limited because Reliance Industries Limited is a company which has proven its creditworthiness in the market. It enjoys a good reputation in the market, and therefore people are assured of the return on the debentures of Reliance Industries Limited. They are assured that their money won't sink or they won't lose their money. Both corporations and governments frequently issue debentures to raise capital or funds. Some debentures can convert to equity shares while others cannot. So, this avenue of raising finance, that is debenture, is open for both corporations as well as government, and as a, the conversion of debentures into equity shares or even preference shares is one of the accepted modes of redeeming these debentures. So now let us understand features of a debenture. Now features of a debentures are, first is interest rate. So the more formal term of the to refer to the interest rate of a debenture is coupon rate. This coupon rate is determined, which is the rate of interest that the company will pay the debenture holder or investor. This coupon rate can be either fixed or floating. Now, what do you mean by fixed coupon rate? Fixed coupon rate is the rate which is predetermined. That is, say a company XYZ Limited is issuing 10% debentures in the market. So now in this case, this 10% is a fixed coupon rate. Whereas floating rate is tied to some benchmark, say for example LIBOR, which is London Interbank Offer Rate, or MIBOR, right, which is Mumbai Interbank Offer Rate. So this floating rate is tied to some benchmark and it is influenced by the rate that is in existence on that benchmark. A floating rate might be tied to a benchmark such as the yield of a 10-year treasury bond and will change as the benchmark changes. That is why it is called a floating rate, because it is not fixed. It keeps on changing. Now, credit rating. The company's credit rating and ultimately the debenture's credit rating impacts the interest that investors will receive. Now, credit rating of a company plays a very important role, and also in the fact that it determines the subscription that the company gets on its debentures, and it ultimately impacts the interest rate. Say for a company which is which has a very which has a poor credit rating, it will have to pay a higher interest rate to attract subscription from general public, whereas a company which has a very high credit rating can issue debentures at low interest rate and people will be willing to invest or put their money in buying their debenture. Credit rating agencies measure the credit worthiness of corporate and government issue entities. These entities provide investors with an overview of the risk involved in investing in debt. So this credit rating process is entirely aimed at providing investor with an idea as to what exactly are the risks that they are facing in investing in these either corporate issue of debenture or government issue of debentures. Now, third is maturity date. For non-convertible debentures mentioned above that we learned about earlier, the date of maturity is also an important feature. This date dictates when the company must pay the debenture holders. The company has option on the form of repayment will take. We will understand the various types of modes of redemption of these debentures later in this very PPT. So most often it is as redemption from the capital, The issuer pays a lump sum on the maturity of the debt. For this purpose, even debenture redemption reserves are maintained by the company, which is a sinking reserve where the company puts aside certain sum every year till the date of maturity of the debt. Alternatively, the payment may use redemption reserves where the company pays specific amount, like I just explained amounts each year until full repayment at the date of maturity. So this was about maturity date. Now moving on, let's understand the various types of debentures. So various types of debentures are first secured and unsecured. The secured debentures create a charge on the assets of the company, thereby mortgaging the assets of the company. So the secured debentures are, in short, mortgage. They are issued by mortgaging the assets of the company, and thus they are secured. That is, the return on them is assured. Then now unsecured debenture do not carry any such charge or security on the assets of the company. Now second is registered and bureaued. A registered debenture is recorded in the register of debenture holders of the company. A regular instrument of transfer is required for their transfer, whereas in contrast, the debenture which is transferable by mere delivery is called a bearer in debenture. For transferring a bearer debenture, you need to only transfer the papers related to the debenture to the recipient. Whereas for a registered debenture, you need to get the change in ownership registered in the register of debenture holders of the company, according to which the returns are given to the registered debenture holder. Now third is convertible and non-convertible debentures. So convertible debenture can be converted into equity shares, nowadays even in preference shares after the expiry of a specified period. On the other hand, a non-convertible debenture is those which cannot be converted into equity shares. They are redeemed at the end at the maturity date, either by payment of lump sum or not even nowadays in now non-convertible debentures, the companies may redeem those debentures in stages, or they may amortize those debentures. Now fourth type of debenture is first and second debenture. A debenture which is repaid before the other debenture is known as a first debenture, whereas the second debenture is that which is paid after the first debenture has been paid back. So this is the preference, the ranking of preference in which those debentures are redeemed. That is why they are called first and second. Now moving on, let's understand advantages of debentures. So advantages of debentures are investors who want fixed income at lesser risk prefer them, because these debts are generally secured, and in case of fixed rate debentures, there is a fixed income that investor earns periodically. So there is lesser risk involved as compared to other instruments such as equity. As a debenture does not carry voting rights, financing through them does not dilute control of equity shareholders and management. So it is a win-win situation for equity shareholders, because they neither have to dilute their control over the company, nor do they nor do they have to move to a more expensive mode of financing. Now, financing through them is less costly as compared to the cost of preference or equity capital, as the interest payment to debenture is tax deductible. The company gets tax benefit on the interest that they pay on these debentures. So, compared to preference or equity share capital, debentures or debts are less costly. The company does not involve its profit in a debenture, and the company does not need to as such distribute the profit, or there is no decision of plowing back the profit or distributing to, as is the decision in case of equity shareholders or preference shareholders. There is a fixed rate, or even in case of floating rate, there is a certain rate on which they have to pay the debenture holders, and thereafter there is no claim or stake of debenture holders in the remaining profit. Then last is the issue of debentures is appropriate in the situation where the sales and earnings are relatively stable. Why is it so? Because debentures are cheaper mode of raising capital as compared to any other modes, because as again I pointed out in third point, they are tax deductible. Now let us understand disadvantages of debentures, because everything has both pros and cons. So each company has certain borrowing capacity. With the issue of debentures, the capacity of a company to further borrow fund reduces. Now, each company has a borrowing capacity. This borrowing capacity depends to a very great extent on the earning before interest and tax that a company has earned, or even on profit after tax. So, there are financial ratios like interest coverage ratio, which is used to calculate the capacity or the risk appetite of a company, the level to which a company can bear these risks and bear these fixed interest rate payments without eroding their net worth. So every company, no matter how prosperous, has a certain capacity beyond which if it raises debt, then their net worth or their earnings, their profits will start eroding. So, with the issue of debentures, the capacity of a company to further borrow fund naturally reduces. With redeemable debentures, the company has to make provision for repayment on the specified date even during periods of financial strains on the company. The company needs to put aside these amount for later date or for maturity of these debentures, because generally redemption of debenture involve huge amount and they naturally put a financial strain on the company, especially during the period when the company is going through financial crisis. Now, third point is debenture puts a permanent burden on the earnings of company. Therefore, there is a greater risk when the earnings of company fluctuate. If the earnings of a company keep on fluctuating and are not stable, then the strain on maintaining the profit as well as putting aside money for redemption of debentures puts a huge strain on the or creates a financial burden on the company. So these are the disadvantages of debentures. Now let us look into redemption of debentures. So typically redemption of debenture can be described as the process of repaying debentures issued by the company to its shareholders. It can be done at premium also or at par. That is, while repaying debentures or the amount on debenture, you at par means you only pay at the face value of the debenture, whereas redeeming at premium means you are paying something extra or paying a premium on those debentures along with principal amount. In other words, it is the process of repaying the principal amount to debenture holders. It is noteworthy transaction for most companies as the amount required for redemption is quite substantial. Noteworthy means important. So obviously redemption of debenture is a very important transaction for most companies as the amount required is huge or substantial. So the company needs to be prudent in putting aside the money or maintaining their profits so that they are in a position to redeem their debentures without having a very adverse impact on their financial position. Once debentures are redeemed, the issuing company discharges its share of liability and takes it out from the balance sheet. Of course, once the debentures are redeemed, you need to remove them from the liability side of balance sheet. In the same way, if either equity in case of those redemption where conversion happens, that is convertible debentures, or cash or bank balance get impacted if the company pays these lump sum amount on non-convertible debentures. Resultantly, business build a robust provision out of their gains and accumulate capital for reclaiming debentures. Again, the same point that the for redeeming these debentures, the companies build a very robust provisions out of their gains and accumulate profit capital for reclaiming debentures. Now there are these five ways to redeem debentures. The first is lump sum payment. Now suppose a company has issued debentures worth rupees 100. So on the maturity date, they will, depending on if say if the debentures are to be redeemed at par, then they will pay back rupees 100 as on the maturity date and get done with it. If say it is at premium of rupees 10, so the company will pay rupees 110 to its debenture holders and get done with it. And the second method is installments. So installment happens when, say suppose the duration or the maturity duration of the our debenture is 5 years. So every year this company, say for 100 rupees debenture, if they have issued debentures worth rupees 100, then they will divide 100 by 5, that is 20, and they will keep on paying rupees 20 every year till the end of 5 years. So this is payment or redemption of debenture through installments. Now open market purchases. So this is the way where in open market the company simply purchases those debentures or buys back those debentures. Number 4 is conversion into shares. So conversion into shares happens when debentures are converted into either equity shares or preference shares into fixed number of equity or preference shares, right? So this is what about conversion to shares. And the fifth is call option and put options. Call option happens when the company has a right to call back or to purchase or repossess their debenture at a specific price, whereas put option happens when the debenture holder has a right to sell debentures back to the company at a certain rate. Now call option happens when the either interest rate or the price of debenture starts rising, so the company exercises call option to ensure that, say if the interest rate has fallen, say a company has issued debenture at 10% interest rate, but now after 5 years of the after 5 years of issue of that debenture and maturity period still remaining is suppose 15 years, and the rate of interest on those debentures has fallen to say 6%, and the rate of and or the coupon rate on the debenture issued by the company is 10%, then the company will prefer to buy back those debentures because it's shelling out more money. So in that case, if the company has call option, the company will call for its debenture and redeem those debentures. Similarly, in put option, in case of put option, the debenture holder has a right to sell these debentures back to the company. Say in case, um, suppose the yield or or the interest rate that a debenture bears is 6%, but the rate in the market on similar kind of debentures has risen to 10%, then the debenture holder can, if they so want, sell their shares to back to the company if they have a put option. So that is so these are the five ways to redeem these debentures. So this is all for today, and thank you very much.